In uncertain economic times and emotions running high, we don't know what to do with our money. Do we invest it? Do we save it? Do we leave it under our mattress? Do we put it into Bitcoin and cryptocurrency? It's difficult to know. This episode aims at answering some of those questions for you and giving you a direction forward. We're going to be giving you key financial concepts like the rule of 72, dollar cost averaging, and some other things which will help you to know where to put your money and how to invest your money. So if you're feeling anxious or unsure or uncertain about your financial future, this one is for you. Let's go ahead and get to it. What's going on, everyone? Welcome to another episode of the Success Spectrum Podcast. I'm your host, Kadeem McLean, and today we're going to be talking about the uncertain economic times that we're in and some strategies that can help you to navigate through this whole thing. So where are we currently? As of this recording, S&P 500 for the last month has been down 8%. That is a significant drop for the S&P 500. Also, we just had elections for the states, of course, and for Canada. And President Donald Trump just took presidency again. Now, what happened is there are tariffs. There is a tariff war going on, essentially. And he increased tariffs, Canada increased them back, and he increased them, Donald Trump, for Mexico, for Canada, and for China. Now, what that means as a consumer, for anybody who's unfamiliar, is we are likely to see increases on items in Canada that are from the States and vice versa. Now, of course, our grocery bills have already been going up and we don't like that, right? Since the pandemic, our grocery bills have been just increasing, we've noticed. And now other items might increase as well. All of this is leading to uncertain economic times. That alone, the tariff wars, is enough to destabilize the economy. And when we really think about it, what do we do, right? It leads to questions. Some questions such as, is it the right time to pull my money out of the market? Do I leave my money under my mattress and just sit on the sidelines? How am I going to navigate and do the right things with my money? Am I currently doing the right things with my money? So we're going to aim to answer all of these questions as we give you some tips and strategies throughout this episode. But one thing I want to point out, which is very important, is a knee-jerk reaction does not lead to wealth. So yes, you see uncertainty in the market, but that doesn't mean you just automatically shift and stop doing what you've been doing, because that knee-jerk reaction to what's happening in the economy is likely not to lead to wealth. We need to work on proven strategies that can help us to stay calm and to build our wealth even through these uncertain economic times. And that's exactly why we're talking about the rule of 72, dollar cost averaging, and inflation on this episode. So what is inflation? Inflation is really the silent wealth killer. And for anybody in Canada, it's been about 2% on average for the past years. And what it is the cost of goods and services rising over time. When you look at a Tim Hortons coffee, or rather I'll say French vanilla because I don't really drink coffee, but a French vanilla, I remember a time when it was about $1, maybe $1.25 for a French vanilla. Now it's what? Maybe like $2.19 for a small, somewhere around there. And a donut, I remember donuts used to be 70 cents, 60 cents, and a bagel around the same price. Now I don't know how much they charge for those things. Maybe it's $1.25 for a bagel, $1.25 for a donut. And that's a small example, but think about gas prices. I remember when gas prices were 60 cents, 70 cents. Now you're lucky to see it under $1.40 now. House prices, grocery bills, grapes, all these other things, you can think about it. Your bills rather have been increasing. What you're paying for these goods and services has been increasing over the years. That is why it is known as a silent wealth killer, because you can leave your money under your mattress and think that you're saving money, but in reality, you're just losing money, because as you're keeping your money under your mattress, it's not growing for you, but inflation, the cost of goods and services, is still increasing over time. That means your dollar, your buying power, is decreasing. Your $1,000 today or $1 today is not going to be able to buy the same thing in 6 months or a few years down the road. We got to make sure we're making our money work for us. You work hard for your money, so why not make your money work hard for you? And that is inflation. It's the cost of these goods and services rising over time. Now, again, you're guaranteed to lose money if you leave your money under your mattress because of this inflation thing. Silent wealth killer. This is why it's important to understand, always do your own research, disclaimer, but this is why it's important to understand and to invest wisely, because when you're investing, your money can grow for you above that inflation rate, and therefore you're actually making money. Your money is working for you to bring back more money. Lastly, to this point, it's been said that if you miss the 10 best days in the market over a span of 20 years, that will decrease your returns, your growth, by half. You will miss out on half of your growth over 20 years if you miss the best 10 days in the market. You'll hear me say this a few times throughout this episode, but this is why it's important to not worry or try to time the market, but focus on time in the market. Not timing, but time in the market. Because if you miss those 10 best days, you miss out on half your wealth. So what is this Rule 72 thing that we talk about? This is something that was made popular by Albert Einstein. Of course, compound interest was his big thing. He said it's the, I think, 8th or 9th wonder of the world, depending on how many there were at the time. But it is a powerful concept. And what the Rule 72 says is if you take 72, you divide it by your rate of return, the results will tell you how many years it will take your money to double. And I remember when I was with a certain company, I'm not going to say the name of the bank, but it was the Green Bank. And I had a high interest tax-free savings account giving me 1% return. And I thought I was doing something good. But when I heard about this Rule of 72 thing, I said, wait, hold on. This doesn't make sense. Are you sure it's 72? This doesn't make sense. But 72, I did the math, divided by 1 equals 72. So I said, wait a second. That means in this 1% account, it's going to take my money a whole 72 years to double. That is way too long. So I said, okay, hold on. What can I do? Where can I go to get a higher return rate to double my money quicker? Let's say you were to find Miracle Bank. Miracle Bank says, Mr. and Mrs. Client, we're going to give you 4% return and you're going to give us $10,000. I know you're 29 years old today. We'll give this money back to you in retirement. So you put in $10,000 at the age of 29 with Miracle Bank giving you 4% return. And I say Miracle Bank because think about the return that your banks are giving you. It's probably closer to that 1%, like I just said. But anyhow, that 4%, you leave it there. Now, we all know that the banks are smart with their money. So they're not leaving that $10,000 in their vault. It's not sitting there per se. What they're doing is they're taking that $10,000 and now they're lending it out to me on a line of credit or a credit card charging me 19 or 20%. They're lending it out to somebody else for a car loan, for a personal loan, for a mortgage. Minimum, I believe that a bank will get back on their money because they are also investors, or they have investments, I should say. They can get back 12% easily. That's my personal opinion. Now, if the bank is giving you 4%, 72 divided by 4 equals 18. That means every 18 years, this money doubles for you. You put in 10,000, by the time you're 65, you have $40,000. Last I checked, that's nowhere close to enough to retire on. Now, there's also this 12% that the bank is actually making on your money, even though they promised you 4%. 72 divided by 12 equals 6. That means every 6 years now, this money is doubling for the bank. Not for you. I know it's your money, but it's doubling for the bank. By the time you are 65, the bank has made $640,000. You're going to come in to collect your retirement, and they're going to say, Mr. and Mrs. Client, thank you for being such a loyal customer. Happy retirement. Here's your $40,000 and a cup of free Tim Hortons coffee. Thank you for being a loyal customer. And I paused there purposely because when I first heard this whole thing, the Rule 72, it stung me a little bit. And I hope it stings you a little bit in the right way as well, because it stung me in the point to say, again, where can I go to get my 6%, 8%, 12% higher percentage? And thankfully, I found it. And I've been investing ever since. So I'm no longer getting that 1%, that 2%, not even 4%. I'm getting much higher returns, thankfully, because I said, wait, where are the banks investing? And I started investing where they're investing. So to get access to that, you can reach out to somebody who has access to that as a financial professional or myself, and we can talk about it. But again, if you're getting that 12% return, this is all to say, again, not that the banks are bad, but let me just say this. This is to point out that if you don't know how money works, somebody else is going to make money using your money. You need to understand the rules of the game and how money works so that you can put your money to work for you, know where to put it and how to invest, which we'll talk about shortly, so that you can make your money work for you to get your 6, 8, or 12%. Because this 1% you're getting, you're losing money. Because again, inflation, let's say, is at 2%. You're losing 1%. What are you going to do? So hopefully you understand the importance of the Rule of 72 from that example. Do you have a child in your life who loves to color? A niece, a nephew, a son, a daughter, a neighbor? Remember when we grew up, we did A for apple, B for banana, and so on? There's something new in town. It's going to change generations financially. It's called Money Magic, ABC. This is a financial coloring book. They get fun pictures to draw, to color in. But instead of A for apple, we got A for asset. We got B for budget. We got C for crowdfunding. This is going to, while they're enjoying themselves, teach them the financial terms that we didn't know growing up. The financial terms that some of us still don't know. Financial literacy is key and vital. And instead of learning A for apple, learning A for asset at such a young age, it's going to change their financial mindset into the future. They'll be able to start off ahead of the ball, right? Ahead of the game. So go ahead and get yourself a copy and give this gift. Give the gift of financial literacy to your children and the children in your life today. Go ahead and click that link in the description and get yourself a copy. Now, dollar cost averaging is another thing that's so important, because once you find out where to invest, once you find out where to invest, whether it's an ETF, whether it's into your own stock account that you created, whether it's in Bitcoin or some cryptocurrency, here's a strategy you can apply to minimize risks and potentially increase your gains. And it's called dollar cost averaging, DCA for short. And what this says is, let's say for 6 months, you're going to invest $100 per month. $100 per month for 6 months. Month one, it's at $10 per unit or $10 per share. That means your $100 is going to go and buy as many shares as possible at $10 per share for that first month, meaning you're buying 10. The second month, the market goes down to $5 per unit. Now you're putting in $100 still, 100 into 5, of course you get 20 shares. Now month 3, this is where it is at $2 per unit. So $100 into 2, of course, you're going to buy 50 units. Now month 4, this is where the market is dropping. This is where the news is telling everybody we're going into a recession, take your money out of the market. It's going to be difficult times. Your friends, your family, your neighbor, they're all telling you it's difficult times. We're in a recession. Take your money out of the market. Don't invest. My question to you is, are you going to take your money out or are you going to keep investing? Because this month it's down to $1 a share. We went from 10 to 5 to 2 to 1. $1 per unit, $1 per share. Are you investing or are you taking your money out and calling it a day? Answer, decide. Now, let's say you kept investing. $100 in month 4, $1 per unit, you're buying, of course, $100. Month 5, same thing. It's still at $1 per unit, you're buying 100. Month 6 now, it comes back up to $2 per unit. You put in $100, of course, you're buying 50. Looking at this, do you think you made money or do you think you lost money? You put in $600, you now have 330 units that you bought throughout the course of these 6 months. 330 multiplied by 2, because you're selling it in month 6 at $2 per unit, you have $660. You made $60. So the reason you made money is because those down periods when it was at $1 per unit, when everyone was telling you to take your money out, that's where you bought the bulk of your shares. If you didn't buy during those time periods when it was at $1 per unit, you would have lost money. Without question, you would have lost money. But because it was on sale, you made money when it returned, when it came back, because you continued to purchase. That's what dollar cost averaging is. Regular intervals of consistent purchases. In this case, $100. That's a fixed amount. $100 through every month for 6 months. That's consistent. That's dollar cost averaging. Now, of course, for the example, we gave 6 months, but ideally do it over longer periods of time. But another example for this is, think about tissue. You walk into the grocery store. Normally it's $5 per box and you normally get one. Today it's $1.50. Are you buying one or are you buying a bunch and stocking up? Same thing happens when the market is on sale, when it's at $1 per unit or $1 per share. It came down from when it's normally at 10, but it dropped. It came down. So yes, we're going to buy more. That is the way it works when it comes to dollar cost averaging. Always do your research. I'm not telling you what to do. I'm just sharing some information with you. These are certain financial concepts that can help you. Now, if you took that $600 and you dumped it into the market when it was at $10 per unit, even if it went down to 5 to 2 to 1 and came back up to 10 without you putting anything more into it, you would have lost money. Even if it came back up to 10, you would have lost money. It has to go higher than that for you to make your money back. That's why spreading your risk and dollar cost averaging is so important. It takes the emotions out of it. It helps you stick to a proven strategy that has worked over time for many people. And it helps you to average out your cost per share, which again helps to lower that risk. Right? And you focus on building wealth steadily through drips. I wrote a book for you, and it's called Wings of Abundance, your strategic guide to uplift and empower you to financial overflow. One thing I like to talk about is the financial map. There's 2 points on any map. One is where you are, and the next one is where you want to go. This book, this strategic guide, will help you to determine where you are and where you want to go, and will also help you to bridge the gap. We talk about money mindset. We talk about the application of all the information that you know about finances and all the information that's in this book for you. There's resources in the back of the book. There's bonus information in there. We talk about how to overcome debt, how to build wealth, generational wealth. There's so many different strategies in here that you can utilize for yourself to get you to where you want to be financially. So again, if this is something that sounds interesting to you or anybody you know, because it's written in a language that even teenagers could read it, go ahead and click that link in the description and get yourself a copy. So a very quick episode for you today, because I wanted to make sure I release an episode on finances during these difficult economic times. Some things to remember here: stay invested. It's not about timing the market. It's about time in the market. If you're a day trader, obviously, you know I'm not talking to you when I say that, but it's about time in the market. For the regular folk here, we're not day traders. Time in, not timing, time in the market. Use the rule of 72 to find out where to invest. How much can your money grow by? Are you going to stay on track to reach your goals using this rule of 72 formula? Now, stay consistent with dollar cost averaging. That's important, because especially when prices are down, again, because you're buying the bulk of your shares when it's down. Google, Apple, Amazon, Microsoft, a bunch of big companies. These companies are probably not going anywhere in the next few years. So if they're down, personally, I'm buying more. If Bitcoin comes down, personally, I'm buying more. I'm still doing my dollar cost averaging, but I'm personally buying more because I know these companies are coming back. That's just me personally. I'm not telling you to do that. Do your own research, but that's how I go about it because I understand dollar cost averaging and I've seen it work for years. So once you start doing dollar cost averaging, you'll see gaps. You'll be, oh my gosh, this is coming down now. Amazon's not going anywhere. Let me just put an extra 200, an extra 500. Now, here's the other piece to it. You want to make sure you start where you are. If you have $50, start there. If you have 500 or 5,000, start there. Start small because you don't want to drop everything in. You don't want to put all your eggs in one basket. Always do your research. Don't deviate too much because your friend's telling you this, even though they're not really a professional or haven't been doing it themselves per se. Always do your research. Start small and see how it works. Don't put all your eggs into one basket because I've had people come to me and say they put all their money into one thing. How do I get it out? You should have come and talked to me before you did that. I want to give you advice. I don't want to mitigate the risk after the fact or try to recover from it. I want to help you in the beginning to grow your wealth, not to recover from a loss. So do your research, make sure you start small, and don't let inflation steal your future. Do not let inflation steal if you're leaving money under your mattress, in your vault, in your safe, it's not growing for you. You're losing money. Where can you put it to make it grow for you? Saving is important. Investing, which is different because that's where you get the real growth, is as important. Just as important. You want to make sure you save and you want to make sure you invest. All right. So your future self will thank you if you stick to this plan. If you come up, you use this information and you stick to it. When you're 40, 50, 60 years old, you're going to look back and you're going to have to thank the 25-year-old you. You're going to have to thank the 30-year-old you, the 35-year-old you, because if this 30-year-old you does not put away money now, you'll never reach your goals financially. You will not reach that goal. And then the 60-year-old you is going to maybe looking with regret or whatever the case might be. But if you do start putting the money away, you can look back when you're, older and say, oh, I got to thank the 30-year-old me because without the 30-year-old me, I would not be in this position, living the life I desired now. It's thanks to that 30-year-old me who made the business decisions or the financial decisions that put me in this position. So again, stick to it because finances is not about today. It's about your future self. Your business decisions should not be about today. They should be about your future self, the future state that you want to be in, the future lifestyle that you want to have. So again, it's not about the present per se, it's about the future. Review your investments today. What is your investment strategy? Are you playing the long-term game or are you playing the short-term game? Focus on the present or focus on the future. Start where you are, to reiterate, with whatever you have, $25, $50, start now, because if you don't, you're missing out on that wealth. The wealth you're going to miss out on between now and this next 6 months, it can be very significant. So start now, especially because we're in a down market. Start now. Do your research, but start now. All right. Now, my question to you is, what is your biggest fear about investing right now? Drop it in the comments, send me a message because I want to know, what is your biggest fear about investing right now? And one of the reasons I ask this is because first, I hope this episode helped to calm those emotions, calm those nerves, and give you some strategies on how to invest to make it simpler for you. And if this episode was helpful for you, I ask you to share it out with somebody. But the reason I asked that question is because I want some feedback from you. Drop it in the comments, send me a message like I said, because I want to know if these episodes are helpful for you and if there's any specific questions you have, so maybe I can cover them on the next episode. I want to know if it's helpful and what type of content I can continue to create for you to fill these episodes with value for you. So again, thank you for stopping by. If it was helpful, share it out with somebody, like, subscribe. Kadeem here, and I'll see you in the next one.